Hello everyone, welcome back to Upside Down Data. Today I want to talk about risk with the NASDAQ. If you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter where we put out regular updates about our risk indicators and more. So today I want to do something a little bit different from the normal crypto content, really because, right now, if you've been following the markets, you're quite aware that the macro picture is quite unpleasant right now, right? There's the very unfortunate situation of the war with Ukraine and all the ripple effects that that's been having. And of course, markets care a lot about these types of events. Markets react quite heavily to things like wars. And so that, in conjunction with things like inflation and fears about how in the United States the Federal Reserve is going to respond to that situation, there's a lot of uncertainty and fear in the market. So what I wanted to do is try something a little bit different and try to apply our risk indicator, the upside downside potential indicator, the UDPI, to the NASDAQ and see what kind of information we can glean from that. Then I also want to compare that to what the RSI is saying about the NASDAQ right now across different time frames. So what I'm showing you here is the long-term UDPI. So this is the exact same model that we apply to crypto assets, but now I'm just applying it to the NASDAQ instead of those crypto assets. And when you look at this, you'll notice it's quite interesting, as it looks a bit different from what we're used to seeing with the UDPI for crypto assets. And part of the reason for that is that when you think about the stock market, it doesn't behave like crypto assets in a lot of ways, right? The stock market is actually relatively low in volatility, especially compared to crypto. It's quite low in volatility. It tends to have these periods of just kind of steady up with just some kind of mild volatility going around, then these occasional big runs up, and then just these violent moves to the downside. One of the things that's really interesting about the stock market compared to crypto is that crypto, you'll get this kind of violent volatility in both directions quite often. You'll get that, those parabolic moves to the upside, then those parabolic moves to the downside. With the stock market, more often than not, when you get those parabolic moves, it's actually more of the downside. You get this really violent volatility to the downside, and then just kind of oftentimes just kind of steady upward movements out of that. And so it's a bit of a different volatility profile from what we tend to see in crypto. And what ends up happening when you apply the UDPI is it does still do what we'd expect it to do, right? It'll identify these topping out points as well as these lower points, these bottoming out points. But you'll notice it hangs around kind of this neutral zone very often, right? It's kind of just hanging around. And I'll show you in a minute the exact levels, but it's more or less 1 and -1 for a lot of the time, just kind of ping-ponging around depending on the little bit of volatility as we go. Now, one of the things that you'll notice if you're looking at it, right, is that there have been 2 times we've gotten up into these red zones in the past. The first time in the NASDAQ's history was the dot-com bubble, where the NASDAQ really went parabolic moving into that and had this really precipitous downside because it was around an 80% drop in value of the NASDAQ during that period, dwarfed the financial crisis of 2008 in terms of the downside move that happened here. This is a massive sell-off on the NASDAQ. Then we also saw that here in 2008, and again, I identified that as being this kind of green zone here. But you'll notice we're now back up into the red zone, though it does look different than right back here, right? Here we just kind of went up, more or less parabolic blow off top, and then dropped. Here we've actually been hanging out in the red zone for a little bit of time, for a while. And I want to show you the raw output just so we can see this a little bit more clearly. So I should mention this is the long-term UDPI. So this one cares about moves that play over months to years. And so in the crypto space, that tends to be a quite macro outlook, right? Because in the crypto space, things tend to happen quite a bit more quickly than in the stock market. In the crypto space, a market cycle can last, a year or two, couple of years to have, the full thing. With the stock market, these moves play out over way longer periods of time. Just something to make notes that this is, again, the exact same model, but this is something that cares about a much shorter time frame than the stock market tends to care about. The stock market being something where we've been in a bull market ever since 2008, right? It's one of those things where with Bitcoin, Bitcoin wasn't even around for as long as this current bear market has been going on since the beginning. So here's what we're looking at, and this is what I was talking about right here. This latter part here. You'll see this really massive explosion that we had coming out of the March 2020, the COVID crash here, that actually spiked the UDPI very high. And what that basically meant was that at the time that happened, we had realized about as much upside potential as we were going to be able to realize in that short term. And indeed, you know, if we look back here to look a more closely, we did end up pulling back a bit from the top of that run there. If you were around the market and following, you probably remember that when that happened. And then, but then we've been kind of moving up, you know, more or less ever since. But you'll notice we've been hanging out in these really high risk zones. And as I was mentioning, kind of throughout the NASDAQ's history, what you'll see is that historically it's actually spent most of its time, the vast majority of its time, more or less between 1 and -1, right? Right around that kind of break-even point between, you know, upside and downside potential. And so essentially one of the ways that you can kind of interpret that is that, you know, the stock market is just kind of doing its thing most of the time. It's just kind of shooting up upside potential, you know, going back down, taking some of the downside, taking up the upside, and it's just doing that in this overall just kind of steady uptrend. And then you might occasionally then lead into these kind of bigger buildups that then drop you down into these lower levels, like the Great Financial Crisis right here. And so more or less for the bull market that we're, you know, currently in, assuming that the bull market's still going to go on, obviously a lot of people are asking, you know, is the bull market over? We'll get to that in a minute. But you'll see it just spent a lot of its time just in between these levels, but now it's been slowly picking up. You'll notice the uptrend in realized upside potential. And this is something that we talked about in crypto a lot in terms of bullish versus bearish structure on the UDPI, where if you see this kind of uptrend overall in the UDPI, that's a bullish structure. That suggests that you're probably in a bull market, whereas a bearish structure if you're seeing this downtrend in the UDPI, where you're seeing kind of these lower lows being set in and lower highs relative to previous ones in that trend. And so really what we're seeing here is just this build up into this bull market. But now the question is what's going on right here. And you'll notice that with this correction that we're in right now, you'll see how the UDPI has dropped precipitously. In fact, it is at the lowest point it's been since the COVID crash, since the March 2020 crash, now getting back down to zero. You know, we had spent, ever since the COVID crash, we had not been getting close to zero. We'd actually been hanging out between 5 and 3, in fact, all this time. And now we're dumping down to here. So what could that mean, right? Well, the one possibility is that we're looking at something like, you know, 2018 or like the March 2020 crash, where this is a really big reset moment for the markets, where maybe now this will form a bottom somewhere in this general range, and then give us all this new upside potential to work with as we might rally out of this, right? So you can think of this being a reset button where maybe we're going to be able to rally out of that. But the more pessimistic possibility of it is that the dam has burst to some degree, and that we're actually going to be getting into something more like what we saw over here, or potentially over here, just starting at a higher point, where we're seeing this beginning of this rip down in the realization of the downside potential that could, if the floor falls out, see us shoot way further. Because the model is saying there's a lot of downside potential that's realistic for the NASDAQ, even from this point. Even though we corrected off of these highs, somewhere to the order of 20-30%. I have to go back and look at the exact percent that we're sitting at right now. But essentially what the UDPI is saying is that that might just be the beginning if we are actually going to go into a bigger correction. That there's plenty of room below us if we are going to go into a full-on crash like we've seen in 2018 or 2008, or coming off of .com bubble. And so really that's the way I think that we can interpret this data, is that we're kind of at a critical juncture to some degree, right? That if we are going to resume the bull trend, you'd hope that we'd find a bottom in right here, because really, if we ever break below -1, that's historically been really bad. That breaking below -1, except for this one time back here in the early 90s, breaking down below -1 has led to quite precipitous moves to the downside. There's been accompanied by pretty precipitous moves to the downside. And in fact, all of these corrections we've had kind of since the 2008 crash have never gotten us down really below it. This touchdown just below it, but that's basically holding -1. So it's something to watch. Breaking down below this would not be a particularly great sign, in my opinion. But we're going to have to wait and see. So again, with the UDPI, the bullish structure is you'd like to see us be able to set in a higher low. We'll have to wait and see if that happens. But I do see this as being a relatively critical juncture from the UDPI's perspective. Now let's go and look at the RSI, which I also mentioned I wanted to talk about. I want to talk about the weekly and the monthly RSI for the NASDAQ here. So this is the NASDAQ I'm showing you, RSI on the bottom. And you'll notice that if we look at where we are right now, I'll zoom in on this here just so we can see where we're at. You'll notice we're getting very close to the same RSI level we were at during the COVID crash and during the bottom of the 2018 correction. If we can look at some of the percent drawdowns. You know, that was around a 22% drawdown. The COVID crash was around a 30% drawdown from the high. And then if we measure from the high up here, we're about at 22%. So we are about in line more or less with these. You know, the COVID crash being a bit more severe than the 2018, but, you know, or I should say correction crash, you know, whatever you want to call it. And we're re-entering that territory now. And so that's, again, what I was saying, that similar to the UDPI, there's some confluence here to some degree, right? To say that if we're going to find a bottom, where we're at now would make sense for that bottom to form. And that if we start breaking below this, that might start to get more concerning. Because in fact, if we start zooming out and looking back to where we can find an RSI print that was lower than where we're at right now, we have to go all the way back to the financial crisis, 2008. That's the last time that we broke down below these levels. So if we can't hold at these same levels that we've held in the past, you know, that's where we're entering the territory of the 2018 crash, or the dot-com bubble burst. So that's not, you know, that's something to be mindful of. Again, speaking more to this being a critical level potentially. And if we look at the monthly RSI, I think this is another interesting one to look at as well, where this is actually telling a similar story to the UDPI, the long term, although a little bit different in what it's suggesting here. Because you'll notice that we're actually lower on the monthly RSI than we were even during the COVID crash, which I think is pretty remarkable, and about the same level as the 2018 correction here. And again, if we lose this level, which seems has been kind of a level we've visited on the RSI a lot before we're catching a bottom and moving up, if we lose this level, we're again looking at dot-com burst and 2008 as being the only other times in recent history, you know, if you're not going all the way back to into the 90s, where we've gone below those levels. So does that say that we have to just plunge down to these same levels again if we lose this level? You know, no, of course not. You know, nothing has to happen. You know, we could do something weird and kind of unusual and maybe catch a bottom like we did back here in the 90s, somewhere kind of halfway through. So it wouldn't say that we'd have to dump all the way back down. But certainly, it wouldn't look great if we do start doing that. Same thing with the UDPI. If we start realizing some of that downside potential, then you have to ask the question, where is the bottom going to be? Because again, with the stock market, violent volatility tends to be the downside. That when downside momentum builds, it can come to a fever pitch very quickly. That's what we see in history, and the bottom can really fall out. Now, does that mean that we're going to see another, 80% correction like the dot-com burst, or another 50% correction or so like 2008? Who knows? But certainly that is possible. We know that can happen in the stock market, right? You know, that's the way the stock market often goes, is that you'll get these long, protracted bull markets with kind of mini corrections along the way. But then when those crashes come, they're quite violent, and they can take some time to dig ourselves back out of. So I just wanted to talk about this to give some context, because, with crypto, oftentimes we're just very focused on the crypto market itself. But as we know, a lot of the things that have been driving crypto prices are not internal to the crypto market. It's been the broader markets, and equity markets being kind of another gauge of risk taking. Equities being a higher risk asset than bonds, for example, or certainly just sitting in cash. And so really, when I'm just looking at these technical indicators, it's kind of ignoring kind of the more fundamental or macro factors from that perspective. Just looking at the technicals of, in this case, the NASDAQ, it does seem like we're at a relatively critical juncture here. And it doesn't mean that we have to be going into one of these massive corrections, like anything could happen. But certainly with everything that's going on in the world, with the war in Ukraine, all the devastation that's been bringing, and all the disruption that's going to bring to a lot of markets around the world if that conflict becomes more protracted, the possibility of recession is not impossible. And that's where I think we just need to be clear-eyed. And we need to be aware of all the data that's out there and everything surrounding crypto. Because certainly if the NASDAQ does do something like the dot-com burst or like 2008, then I think it would be questionable to think that crypto will just be immune to that kind of downside. I would expect crypto to get absolutely slammed in that kind of a thing. Now, maybe crypto could then, I don't think crypto would be destroyed, and maybe crypto could recover out of that quite well and put in some really nice returns. But I think that if we're in just a panic selling mode across all the markets, I don't think crypto is going to be spared from that personally. Now, of course, none of this is financial advice. You should look at this data, form your own opinion of what you think is going to happen, where you think the markets might go. But I just thought this was useful data to talk about. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with the UDPI, we're all going to make it.